Welcome back to another episode of What's on Your Mind. Joining me on the show this time, I've got Raj Malhotra and David Perlin, who both together represent the US contingent of ITPM Senior Trading Mentors. Now, the last time you guys were both on the show, you had some great stock picks. I know, Raj, last time we spoke, you were looking at long Penumbra and short at CVS. Both of those have performed well this month. And David, I was actually looking at one of yours yesterday, which was a spread trade that you suggested back in March, which was long Visa and short Square. And that's done phenomenally well. It's up about 20% plus to date. So I'm really looking forward to hearing some more ideas from both of you. But before we do get into those stock-specific ideas, I thought it might be a good idea if we get a bit of a feel for where you guys both stand from a macro level, and what that means for your portfolio as a whole. So, David, why don't you kick it off for us today?
Good morning, gents. Yes, macro seems to be in the fore. Bond market has been screaming loudly that economic growth in America is going to slow. We've already continued to see PMIs in Europe weak. And this rolling trade skirmish, which I guess is borderline war now, which is not, I guess what I've been saying to my mentors, to my mentees, is that the market kind of priced in a perfect resolution to this going into the trade deadline. And obviously this is complex and a big deal to negotiate. And once we started to see tweets about the deal not going correctly, I think we all should have reassessed our macro view and the risks to the ongoing kind of easy up market. So I think all of that's in play. What we haven't seen yet, which is kind of Raj's expertise, is this big kind of VIX spike. So as we sit here on a down 250 Dow day, another 1.5% type of declines in world markets, we'll have to see if we start to see a little bit more of that kind of panic that'll be exhibited in volatility markets. But that's the macro backdrop. We made this V-shaped stock market recovery back to highs fairly quickly, fairly rapidly. And now we're settling into a lot of the same issues that were there in the third and fourth quarter of last year, which is, are we slowing down? Can the U.S. continue to grow at the pace it has without the rest of the world kind of converging in the same direction?
Okay, so does that kind of add up with the same macro view that you have, Raj?
To be honest, I'd be very surprised with the lack of protection buying and without a volatility increase, given the uncertainty and the extension, basically, of the trade dispute / war. I mean, the market itself is off, 5% or so off its highs, and the market can sell off 5 to 10% for a litany of reasons, and sometimes no reason at all, just because of profit taking and whatever else. So I'm actually surprised that we've seen very little reaction to what was, like what David said, was supposed to be an absolute certainty to now a lot more uncertainty. I mean, I think that's one thing that's surprising is I guess the market's never seen a leader like Trump, where he actually thrives on volatility, and the market itself just got used to that by not being volatile and reacting to that. And then one more thing that I think that in terms of going forward, it's hard for me to see the U.S. having the growth of the early years of the Trump presidency, given that the rest of the world is lagging. It's hard for the U.S. to just keep performing so well and everybody else dragging like that. That has to those things have to close the gap a bit. So I'd be surprised. I'm not saying the U.S. is going to go into recession by any means, but maybe like a 2.5% GDP growth is much better, and because of that, I've become more defensive in my portfolios. But I've some of the names I've highlighted in the past, I've trimmed my exposure to like the really high growth names like Team, which is up 100% almost this year. Pod, Penumbra, some of the biotech names as well. So I've been becoming more defensive names and adding some defensive names in my portfolio, but ones that I still think have growth relative to the rest of the U.S. economy.
Sure. I think what we've kind of seen over the last quite a few episodes of What's on Your Mind with all the Institute mentors is kind of a defensive bias, but not necessarily taking this net short position into the portfolio. It's more like sector outperformance, right, on the defensive side.
Mm-hmm. Yeah, I think we've become more of a, I hate to use this term, but like a stock picker's market where, I mean, it's always a stock picker's market, but even more so I think with the index having limited explosive upside, you have to pick the winners and losers. And that's usually where the individual like David and myself thrive because we can see the whole picture.
Sure. So with that in mind, David, I mean, what sort of defensive stocks have you been looking at?
Yeah, so I actually have a defensive pair that I've been working on, and I'll give you the names and tickers, and then kind of the thesis behind it. But I'm doing work on UNH long, that's United Healthcare, one of the largest health insurance stocks in America. In short, Duke, which is an energy company, utility, DUK. And what we've seen in this kind of defensive tilt, which Raj has highlighted, and a lot of the reason why indices have been able to hang in there this year is a kind of rotation between groups, and as the concern about economic growth has intensified, a lot of the performance over the last few weeks in particular has been borne by utilities, REITs, kind of typical higher yielding, more consistent dividend paying stocks, to the point where the utilities are actually fairly expensive. Now Duke has a 4.25% dividend yield, which is very attractive as 10-year rates approach 2%. But it's trading at 17 times trailing earnings, or 17 times future earnings, and 21 times trailing earnings, which is very rich for a utility, with a PEG ratio of 4.7. So what you've had is kind of an easy rotation, which I think starts to break down and falter, especially if we have some sort of reversion to growth again, as people get through this period, yet another period of kind of economic concern. On the UNH side, medical or health insurance writ large has been suffering as the Democratic candidates for presidency are largely on board. I'd say 70% of them are kind of leading with a Medicaid or Medicare for all platform, which is to say that the U.S. government should be the insurance provider for most people. Now, that is obviously business threatening to UNH, Humana, Anthem, pick one. So these stocks have lagged. They're kind of down for the year as the market was up. Going into today, we're still up north of 10%, even with a 1.5% decline today. So they're trailing. They do have dependable earnings, fairly predictable. They have decent yield. UNH is a 1.5% dividend yield, probably a little bit higher today, and low beta. And I think that just within a defensive tilt, I can construct a pair where it might be a little bit longer UNH than short Duke, but I think that on a relative performance that sets up well with that concept. I think that the market's too ahead of itself in discounting this Medicare for all as being a true concept that could actually come to being. I think these stocks and the insurance sector as a whole is going to operate as it has been for many, many years to come.
Sure, and that the outlook as well there would be that you think there could be outperformance irrelevant of risk on or risk off going forward, right?
Precisely, because these groups are largely defensive, so I'm basically choosing two horses within the same race, slightly different sector backdrops, and like I said, I think utilities have just gone a little too far.
Yeah, and time frame is sort of irrelevant, or
no, it's what we like to talk about in the seminars. I think it's 3 to 6 month type of time frame. I'm not expecting this to work in 2 days, and I probably won't have it on for 2 years. It's kind of medium term time frame.
Raj, what about on your side? Are you looking at defensive stocks as well then?
Yeah, I agree with David. Like I said, you have to find more defensive names in your portfolio right here. Just having pure growth names, which has really worked since Trump's been elected, really is not probably not the way to go forward, at least in terms of de-risking your portfolio. So one name a defensive name that I really like is it's in the consumer discretionary space, but it's not really consumer discretionary. It's called Bright Horizons Family Solutions Incorporated, BFAM. So it's really like a childcare, a daycare center, like the largest one in the country. Now, remember when we talk about consumer discretionaries, when you group stocks, sometimes just because what they say on Bloomberg or NASDAQ, it's not a pure consumer discretionary. Like this is clearly not the same as consumer discretionary, like a Bell Resorts or some high expensive vacation. You can do without those. Most people cannot do without childcare. I mean, so. And this is if you look at the numbers, they grew 35%. They're expected to grow at 35% this year. They earned $2.66 a share last year. This year, they expected to earn $3.59, and next year they're expected to earn about $4.10. So 35% earnings growth this year, probably not about 14% next year. But I still think there's upside to that number, and I'll explain why that is. Like I said, they are they're center-based backup daycare. They're the largest one that is daycare that's associated with companies. So as women are much more important part of the workplace, and with unemployment 4%, women are obviously as important, if not more important than men in our workplace. And for companies to keep employees, this is a kind of a thing that they have to offer their employees, or else women will just leave the workforce and the companies will be completely screwed. So I just see little downside for this other than like a full recession. And I've been buying the stock since like 110, 115, trading in the mid 130, around 135 here. It's it's got, if you look out the options, I'm looking out to December, and I'll explain why. But I really think there's not too much downside here. And one real potential catalyst that a lot of the market's not talking about is, we all know Ivanka Trump is Trump's favorite person in the world. So she's proposed repeatedly since he's been elected this childcare bill, which would potentially be a one-time $1 billion investment to increase childcare to underserved populations. So I think that's one thing that Trump will bring out on the campaign trail, how he's protecting, how unemployment's low, he's protecting mothers, he's protecting women. It's all about America first, protection, women, we care about you. And that's one thing that he's going to use repeatedly on the campaign trail. Now, while Democrats don't agree with his budget right now, I think that's one thing, if they pick and choose in things they agree with him, that's probably in the small percentage of things that Trump and the Democrats will agree upon, is investing into childcare and protecting mothers and lower income families. So, options aren't the most liquid, but one option strategy I do like is buying out to December. You get two earnings cycles. You buy the 140, 160 call spread and sell the 125 put. If you look at the screen right here, you can pay around $6 for the call spread and sell that December 125 put for $3. I don't think there's much downside. 10% low from here. I'm definitely a buyer of the stock. I've been a buyer lower than that, and I think there's, like I said, there's little. Healthcare is one thing we will not. Childcare is one thing people will just not sacrifice. This is the first thing they will spend on. So there's little downside there. On this, you could pay $3 for the spread and potentially get $17, which is up like more than over a 5.5 to 1 payout. And I just see a little downside for the stock here, and it's a way to be defensive, even if if GDP goes down. This is not where people cut spending.
Sure. And is there other sort of catalyst benefits of owning options on these stocks? Are there things you see on the horizon that could move them?
I mean, I just think that childcare is something that's going to be into the public arena, and by both candidates, by both parties, I should say, by all the Democratic candidates and Trump. So, and like I said, if this thing does pass in any form, the Ivanka Trump child care bill, and something she's championed the whole time, the stock could be up 20% on a headline, and a name that's not very liquid and very well covered. Because I believe they are one of the few childcare companies. Because that's as you know, that sector in the U.S. is very fragmented. It's not a national. Mostly are regional, daycares. I mean, I myself actually have had an investment in a local childcare company where there's like 8 of them. So I think that's not just on a national scale. I like it on a smaller scale, and it's just a cash cow.
David, what about back to you, the pair that you were looking at? Is there anything else you wanted to expand on with those?
Yeah. Actually, there is another compelling reason to have this pair on, and the truth is that there's going to be consolidation in the health insurance field. There already have been a couple of very large deals announced, and a deal blocked, which I think was Humana Anthem. So these companies want to combine, and that's another wind at our back for our long, which I think is important. The flip side, utilities really can't merge, or it's difficult for them to merge. They're highly regulated. They're regulated by the states. In fact, they have a rate of return regulation by the states, basically allow them to make a certain amount of money. So I think, again, that reinforces the fact that in a defensive pair, I have one that has a little bit more upside and more possible scenarios to get to upside.
Right, yeah. You spoke about another company, Raj, that you were looking at before the call as well, which I believe was Dish. Do you want to walk us through your sort of thesis on that?
Yeah, sure thing. So in terms of the sector itself, we know that cable television is certainly under attack everywhere. As millennials become more the norm versus baby boomers, millennials just don't invest in cable. They find other ways to stream television, whether it's Netflix, or they just literally prefer binge watching TV. I mean, perhaps because you guys can't focus on 2 things at once. We all know that, and and that's why you're not very good at trading. But I also think that cable clearly is a place where they're talking about where they're going to spend less money. This is one place that's really, it's just not. Cable itself will not exist the way it does in 20 years. It's hard for me to think that it will. And if you look, but even having said that, the cable, if you look at the cable companies as a whole, they are actually growing. Like the sector itself, they're still expected to earn mid-teens earnings growth year over year. But Dish itself, if you look at their numbers, they earned $3 last year. They're expected to earn $2.47 this year and $1.70 next year. So you can do the math. They're expected their earnings per share is going down 19% this year and expect to be 30% next year. So clearly, that's not a great quantitative model to invest in. And on a qualitative basis, Dish itself has tried a lot of things to really appeal to millennials. Like they've tried Sling TV, which is like it's like mini cable where basically you just buy about 20 or 25 channels just to have a cheaper option for them. They've tried IPTV, and none of this has worked to an extent, but it's just longer term. It's still not the way that people are watching TV. Another thing that's really should hit the stock right now, it's not really been talked about. They're actually facing a enforcement action from the FCC for failing to build out frequencies in a timely manner. Basically, like the FCC gives each company a certain amount of frequencies, like the radio, and they're just not building out those frequencies. They're basically not putting anything on those frequencies. So the FCC is questioning what to do with them, and if they sanction them, and they need this for a timely rollout of 5G in the U.S. So with all the competition they face from T-Mobile and other ones in the FCC, they're encouraging T-Mobile themselves are encouraging the FCC to strip Dish of these holdings, and those licenses are a big fraction of their current market cap. So if that actually happens, there's gonna be free fall very quickly. I'm not saying that's definitely going to happen yet, but that's certainly a potential catalyst that could really cut the stock in half, in addition to the rest of their shitty business.
Yeah. Well, I think we've run out of time for this episode of What's on Your Mind. As always, fantastic to speak to you both, Raj and David. Thanks for sharing your ideas on the show today. There's been a bit of a defensive theme throughout the show, so with most of the stocks that you guys have mentioned, but I noticed that that's more in respect to taking long-short positions across sectors, rather than necessarily taking that defensive theme into a kind of overall net short exposure in the portfolio. And running through some of those ideas with options plays, Raj, has been really interesting. And I think for you guys watching as well, if you're looking to kind of learn to develop your own thesis around certain trade ideas or learning how to structure them in terms of options, we've got all of that information available online on our website at itpm.com. So we have options courses, we've got Forex courses and equity courses up there, so you can look at all of those. You can also inquire about mentoring with guys like Raj and David here, who will help you then take that knowledge to the next level in a practical environment as well. So do make sure you check out all the resources we have up there. But for now, that's the end of this episode, and make sure you join us next time for another episode of What's on Your Mind.